I'm Elvin. This is the first lesson of Essentials of Accounting for Home Businesses. Before we begin, all the slides are tagged. Reference slides refer to content-heavy slides designed only for reference with no need to memorize. Concept slides are slides with heavy and important concepts that are good for us to know at our fingertips. Lastly, application slides refer to slides with examples to help us better understand these concepts. These are the 6 main assumptions in financial accounting. The first being economic entity assumption. This says that the business is its own entity and its activities are to be kept separate from owners. The second assumption is the going concern assumption. This assumes that all entities will operate indefinitely for the foreseeable future. The third assumption is the monetary unit assumption, which states that all data recorded in the entity must be capable of being expressed in dollars and cents. The time period assumption says that the lifetime of an entity can be divided into artificial periods such as months, quarters, or years. The cost principle says that all assets are to be recorded at their cost of purchase. The full disclosure principle says that all relevant events or situations that are necessary for the understanding of an entity's financial statements are to be included in its public filings. There is no need to memorize these. In accounting, there are 5 main categories: assets, liabilities, and owner's equity in the balance sheet, and revenue and expenses in the income statement. So this is an example of a balance sheet. All assets are the sum of all liabilities and equity. As you can see on the left, the sum of 11.88 thousand of liabilities with 4.96 thousand of total equity will equate to the total asset balance of 16.48 thousand. For balance sheet, I use the acronym ALO to remember. Assets equals to liabilities plus owner's equity. Liability and equity have credit balances and they refer to sources of funding of an entity. When entities need to raise funds, they either borrow by issuing bonds or raise equity financing by issuing stocks. Assets have debit balances and are essentially how the company uses those funds raised through the issuance of stocks and bonds. The income statement is a periodic statement that tells us the net income of an entity in a given period. As you can see on the left, revenue less expenses gives us the earnings of the businesses for season 1, which is an artificial period.